Well, thank you all very much for joining us this morning as we review the highlights of the newest mortgage market data. As usual, our researchers will go over trends we think you should pay attention to in our 36-page chart book. We're very fortunate to have Ed Golding joining our call this morning to offer his view of the data. Ed is the executive director of the MIT Golub Center for Finance and Policy. Prior to joining MIT, Ed was our colleague in the Housing Finance Policy Center at the Urban Institute and also was an adjunct professor of finance at Columbia Business School. Ed was the head of the Federal Housing Administration from 2015 to 2017, and immediately prior to that was a senior advisor in the U.S. Department of Housing and Urban Development. Ed spent a lot of his career as an executive at Freddie Mac from 1989 to 2012, where he headed model development, strategy, and investor relations, and developed a national reputation for visionary leadership in housing finance policy. We're very happy to have Ed with us today, even though he no longer works with us. We still consider him a colleague, and we're very happy to have him as part of our family. We'll start the call with 4 highlights from the chart book, including the very robust volume in 2020 that I will present, the role of the Federal Reserve and the impact on the market. Karan Kool is going to take care of that section. The impact of new HUD forbearance for guidelines on mortgage access. Michael Neal is going to cover that. And then Kate Young is going to make her debut appearance talking about housing supply and home prices. Then we'll turn the conversation over to Ed to share his insights. Finally, we'll conclude with some time to answer your questions. If you have questions at any time, please email them to Cheryl Pardo, spardo@urban.org. Again, spardo@urban.org, or add them to the chat room, and we'll be tracking that as well. So with that, let me start talking about overall robust volume. This just shows you this shows you volume sort of from 2001 on. This is the total market, including GSE, FHA, VA, portfolio, and private label securitization. You can see that first half volume was about 1.54 trillion. The MBA, Freddie Mac, and Fannie Mae all produce estimates for volume. The MBA estimate is the lowest for the full year at 3.2 trillion. Fannie is at about 4.1 trillion. If you sort of look historically, you can see that there's only one year that was ever over 3 trillion, and that was 2003. And if you look at 2003 versus now, you can see that the Fannie estimate is in excess of 2003 volume. The MBA estimate is a little bit below. One major difference this year versus 2003 is that the portfolio and private label shares are much lower, and the GSE and FHA VA shares are much higher than we were then. So if we don't exceed 2003 record volume, we're going to be awfully close this year. And certainly this is going to be at least the second most robust year this century, if not the most robust year this century. Next slide, please. This shows you mortgage securitization, and you can see mortgage securitization is already, or agency mortgage securitization is already above 2003 levels. That is year to date, Ginnie and the GSEs together are above 2 trillion, and the estimate on an annualized basis is about 2.7 trillion. Which is above where, and so year to date, we've already exceeded where we were in 2003. And certainly we've still got the remainder of the year to go with relatively low interest rates. This actually covers the data through September. So certainly we are on, so certainly this should be the most robust year for mortgage securitization ever. Next slide, please. And of course, this reflects the impact of heavy mortgage refinancing activity. This just shows you refinancing activity through time, and you can see that refi activity has been extremely heavy this year. It was also very heavy in 2003, although purchase activity was a lot lower. This year, you've had both robust purchase activity because of record low interest rates, as well as very robust refi activity. So again, securitization is going to be the highest ever, especially agency securitization, and total market will be, if not the highest year except for 2003. Next slide, please. It's sort of interesting when you look at net issuance. So we were looking at gross issuance. Net issuance is also going to be very robust this year, but interestingly, it's all in the conventional market. The Ginnie Mae market year-to-date growth has been about 22 billion. It's been about 400 billion in the GSEs. On an annualized basis, we're projecting about 30 billion for Ginnie, about 533 billion for the GSEs. So the growth has basically been almost entirely in the GSEs. Net issuance is going to end up being, if not a record this year, at least very close to a record this year in the agency market. But again, it's all in the GSEs and not in Ginnie. A lot of this reflects changes in FHA's policies toward cash out refinancings. Next slide, please. And changes in VA as well. So if you look here, you can see that year to date, if you break down Ginnie Mae into FHA and VA, you can see year to date, FHA is actually down in size. VA is up about 50 billion. FHA is down about 27 billion, and rural housing is up very, very marginally. But again, very, very lackadaisical growth and an actual drop in FHA outstanding. Next slide, please. The net effect of that is that Freddie is again larger than Ginnie for the first time for the first time since 2015. So very robust growth in the GSEs, less in the Ginnie Mae market, and actual declines in FHA volume. So with that, let me turn it over to Karan Kool to talk about the role of the Fed and the impact on the market.
Thank you, Lori. So what you see on this slide is the blue shows the gross issuance of agency MBS over time, and the yellow shows the Fed purchases over time, and this data is by month. And so you look back through time, you can see clearly Fed increasing its purchases during the Great Recession from 2009 on, and then sort of not buying, and buying almost nothing in 2019 and early part of 2020, and then you see that big spike in Fed purchases early on this year in March and April when the pandemic started. So just to share some numbers on it, the Fed, obviously in March they announced that they would purchase treasuries and agency MBS in any amount necessary to support the smooth functioning of the markets. And in fact, in March, they brought about 292 billion in agency MBS. They followed up with by another, I think, 295 billion in April. And by the way, these two were the largest months of agency MBS purchases ever by the Fed. In fact, in both of these months, the Fed bought well over 100% of the gross issuance. And again, you see that, when you look at the yellow portion exceeding the blue in those 2 months. So really, really extraordinary intervention by the Fed. And then after April, obviously the market had stabilized a little bit. And so the Fed did slow down its purchases. And since May, it has been buying up around 100 to 110 billion dollars worth of agency MBS every month. The other thing I wanted to point out on this chart is that Fed buying so much MBS during that pandemic era was actually a big role reversal for them. because prior to the pandemic, they were actively winding down their portfolio that they had accumulated during the Great Recession era, quantitative easing program. The huge reversal for the Fed. Next slide. Now, this slide shows the total amount of agency MBS that the Fed has owned at different points in time. And again, I think it's important to note that prior to the 2008 crisis, that Fed had never owned agency MBS in any amounts. And, post 2008, they obviously started buying large amounts of agency MBS. And sort of, if you look at from 2013, 2014 on up until 2018, their portfolio of MBS holdings, generally ranged between 1.7 to 1.8 trillion dollars. In 2018 and 2019, they were winding that portfolio down, and just before the pandemic, their total MBS holdings stood around 1.4 trillion, and then the pandemic hit, which you see sort of towards the extreme right-hand side of this chart, and they started to buy huge volumes of agency MBS that I just talked about. Today, the Fed owns just over 2 trillion in agency MBS, again, substantially up compared to where they were not only before the pandemic, but well above their peak holdings of 1.8 trillion after the last crisis. So again, strong, data supporting the extraordinary intervention that the Fed has made in the markets. Next slide. Now, so that's what the Fed did. Now I want to switch gears a little bit and talk about the impact of these actions. What you see on this slide is basically the spread between the secondary, the MBS yields and the 10-year treasuries. And if you look at this chart, again, if you focus on the right, which is represents the pandemic era, you'll see that when actually before the pandemic, in January and February, this spread between the MBS and treasury yields ranged roughly from 80 to 90 basis points. That's in January and February of this year, which is, in other words, MBS yields, secondary MBS yields were about 80 to 90 basis points above the 10-year treasury. By mid-March, though, this spread had almost doubled to 170 basis points, substantial widening of spreads in response to forced selling in the markets. And that's when the Fed aggressively started buying, and the decline and the tightening of the spread that you see after that is almost entirely due to Fed's intervention. And one thing to note here is that not only have spreads come in, but they're actually tighter than they were going into the pandemic. And again, this is important because this spread is one of the key determinants of the mortgage rate that consumers pay. So essentially what Fed's intervention has done is it has basically pushed mortgage rates lower. And we all know, as Lloyd just talked about, that has allowed borrowers to refinance their mortgages in huge, huge volumes. Next slide. Finally, this is just another look at, the spreads. And instead of taking the spread between MBS yield and treasury, here I'm showing the spread between the primary 30-year mortgage rate and the 10-year treasury. And again, you sort of see the spike before the pandemic, followed by a drop post-pandemic, again, showing the intervention, showing the impact of Fed's intervention. The reason this slide is interesting is because if you look at the extent to which the spreads have come in today, you can see that they're still slightly above, about 20 basis points above where they were before the pandemic. And so one reason they haven't come in, obviously on the previous slide, we saw that the MBS to treasury spreads have come back in entirely, whereas this spread is still about 20 basis points wider. And the reason for that is that lenders are still highly capacity constrained today because of lower mortgage rates, which have basically increased the demand for refinance across the board. And so just lenders have no way of keeping up with the volume of refinance applications that they're receiving. And what you see in this slide is basically a reflection of those supply demand dynamics. I'll note that if rates were to remain stable at current levels and refi volumes were to slow down in the current months, one might expect to see this spread narrow further, and that would also translate into lower rates for borrowers. So just to wrap it up, this data clearly it shows that the Fed's action to arrest the panic in the markets was both swift and forceful, and it was extremely crucial in terms of restoring stability to the mortgage market. Furthermore, by pushing rates lower, the Fed also made it very economical for millions of households to reduce their monthly payment by refinancing. And yes, rates are still somewhat elevated relative to the 10-year Treasury, but again, that largely reflects the the ever-changing supply-demand dynamics in the origination market. So with that, let me turn it over to Michael Neal, who will discuss the impact of a new FHA policy on refinance for borrowers enrolled in forbearance.
Hey, no, thanks a lot, Karan, and good morning, everyone. It's always good to be with you. Thinking again about federal government policy, switching over to HUD now. One encouraging development that recently came out was HUD's desire to improve mortgage credit access for FHA borrowers. And specifically, I'm referring to what's called Mortgagee Letter 2020-30, which is dated September 10th, which provided lenders with guidelines for borrowers with the previous mortgage payment forbearance. Part of the guidelines emanating from this letter would allow a borrower who was granted a mortgage forbearance but continued to make payments as originally agreed, would not be considered delinquent and would be treated as if not in forbearance. The guidelines from this letter also provided opportunity for mortgage credit access for borrowers who missed payments during their forbearance period, but have since resolved their financial hardship and exited their forbearance agreement. This would potentially allow these borrowers to refinance. As you can see on the first chart here, on the slide here, we're using publicly available data provided by Ginnie Mae to help calculate the number of FHA borrowers that are in forbearance but current. And you can see on the left-hand side that what I'll call figure 1. First, it indicates that the majority of FHA loans that are in forbearance are also considered delinquent, with about 41% of them 90 days or more delinquent. And we know that these delinquent borrowers could ultimately lose their home potentially, but with certainty their credit score would be impacted because they are delinquent, and that's absent forbearance. While most FHA loans in forbearance as of September were at some stage of delinquency, as you can see on your left-hand slide, a significant minority of these loans are considered current. In fact, of the 697,942 FHA loans in forbearance in September and not liquidated, 31% of them were considered current, which we estimate are 214,963 loans. The third point I want to make is that, amid very low mortgage rates, which I think Karan has already really explained very well, the new HUD rule would help the majority of current borrowers in forbearance reduce their monthly payments through refinancing. You can see that in the chart on the right-hand side. It's important to note here that Fannie Mae and Freddie Mac actually took similar action back in May, allowing their loans that are in forbearance but current to refi. So what figure 2 is showing you is that about 69% of the roughly 215,000 loans in forbearance but current would have a mortgage rate that is about 75 basis points above the average rate on FHA to FHA refis. suggesting that they would be in the money for a rate refi. However, it's important to keep in mind that FHA borrowers in forbearance but current also had a lower credit score at origination than those that refied, that had a rate term refi in September. That difference was about 19 basis points, 680 overall for rate refis and 661 for those that were current but in forbearance. And at the same time, what we know from MBA and from other sources, including our own Hakai, is that mortgage credit availability has tightened. In fact, it's about 18% tighter than its level in February, which is the month just prior to the CARES Act, which implemented forbearance. The main point there is that while the HUD rule certainly will encourage a level of forbearance, tight credit standards that still prevail will make that less practical. With the final point being that while forbearance certainly appears to have been a successful home retention tool, some of its costs, that is, forbearance has contributed to tight credit standards. Some of its costs may actually keep some homeowners from reaping the full benefits of home ownership. Thanks a lot, and now I'm going to turn it over to Kate, who's going to walk through some of the recent trends with respect to housing supply.
Thanks, Michael. So in terms of housing supply, we're at a record low inventory with only 2.7 months of supply available as of September, which is the lowest that it has been in 2 decades. And this is not a small decline. So the months of supply is 1.4 months lower than it was even at the same point last year. And this record low inventory can be explained by current mortgage rates, which, as we've discussed, have been at record lows for several months. Next slide. Housing starts and home sales are both predicted to be higher by the end of 2020 than they were during 2019, according to Fannie, Freddie, MBA, and the National Association of Home Builders. However, there is some disagreement on 2021. So Fannie and the MBA both predict that there will be more starts in 2021 than in 2020, while the home builders predict that starts will decline. And all of these institutions except Freddie predict that home sales will be higher in 2021. Next slide. So national home prices are now 19.4% higher than pre-crisis peak levels. And that is also the case in 11 of the top 15 MSAs. So home prices in 4 of the top 15 MSAs, which are Chicago, Phoenix, Riverside, and Baltimore, remain below their pre-crisis peaks. Next slide. And nationwide, house prices have risen the most at the lower end of the market. So prices at the lower end of the market rose 5% year over year in August 2020, which was higher than 4.2% for the top end of the market and 4.5% for the middle price tier. Next slide. And then finally, despite an all-time low inventory and all-time high prices, homes remain affordable by historic standards because of the low interest rates. So in August 2020, with a 20% down payment, the share of median income needed for a monthly mortgage payment stood at 22.3%, compared to a pre-crisis peak of 35.7%. Although, of course, affordability varies by MSA. And with that, I'm going to pass it over to Ed Golding for his commentary.
Ed? Ed? Cheryl, can you send Ed a message, and I'm going to talk about our, Ed, are you there?
Yeah, I just tried muting and unmuting him, so
Ed, are you there?
yeah, I'll
Here.
keep going. There he is.
Okay,
Can you
great.
hear? I can.
Yes, we can hear
Okay.
you.
You can't see me because the first I've been on thousands of hours of Zoom calls, and for some reason, which I think I know why, I cannot be on video, but people don't really need to see me. They can see this picture of me that was, I think, taken at Urban. If everyone can hear me, I'm going to cover three things. One is Michael did an excellent job, as did Karan, talking a little bit about FHA, but I want to comment on FHA because I just always have to on that. Two, I want to talk a little bit about some research that Debbie Lucas from MIT and I have just completed on credit risk transfer bonds and give you some very brief highlights on that. And then third, a paper that I published on the MIT website with Jung Choi, who I think is on the phone, is on the conference today, and Michelle Aronowitz on the unequal cost of Black home ownership, which also ties into some of this refinancing issue. So let me try to go relatively quickly on those three topics. First of all, FHA, it's pretty natural that its market share declines in a refi market. I think, as all of you know, it is a purchase money, in fact, a first-time homebuyer product. And when you see refis, especially with strong house price appreciation, people tend to refi into the conventional market and avoid the mortgage insurance premium and get lower costs on that. So some of that's natural. It will renew the issue of whether life of loan insurance MIPS are appropriate. That's probably a discussion for another day, but is sort of a useful discussion to have. Again, is FHA appropriately priced for the risks that it's taking on that? But we shouldn't be too surprised at the dip in the FHA market in periods like this. Let me now turn to the credit risk transfer and very quickly talk about some research we've been completed. CRT has been getting a lot of prominence in this pandemic. And the real question is, how is it a good source of capital for the GSEs? The recent proposed capital regulations really cut back on the credit that it was given for risk-based capital. And there was a lot of pushback on saying that the capital standards will penalize and really diminish the use of CRT going forward. In fact, there's an Urban paper that Lori, June, and I have talked about, and I may have missed a co-author, sorry about that, Lori, have talked about the risk-based capital and the CRT treatment on that. Recent research with Debbie Lucas have pointed out some of the limitations of the I'll call it limitations of the CRT market. And the real question that we looked at in this research, two questions was, are CRT prices a good indicator of what's happening in the mortgage market? And interestingly, we did several regressions and basically showed that most of the information content from CRT prices are largely picked up on double B spreads. And so the prices tend to track not the mortgage market, but the general high yield market. That when you put into that, over half of the variation in CRT prices can be explained by the double B spreads. When you throw in things like mortgage delinquency rates, serious delinquency rates, you explain very little of the additional variance. So it really calls into question whether the CRT market is currently functioning as a good indicator of what's happening in the mortgage market. And again, these are not highly liquid markets. They're not, the secondary trading is somewhat limited will develop over time. The other finding from that, from our research basically shows that there is significant price appreciation in the two weeks after issuance on these securities. Again, an indication that the GSEs are leaving money on the table and not getting the full benefit of the credit risk transfer that the market might provide. Just sort of as with any new market, the more you look at data and the more you analyze it, the better. I should mention, as I think all of you know, Freddie has continued to issue CRT in this market. And one interesting innovation in their last issuance that's of note is the DNA5 was indexed not off of LIBOR, but was the first CRT bond issued indexed off of the new SOFR index, which is an interesting development in the market. Will be interesting to track the liquidity of that security going forward. So a lot of interest in CRT out there, both because of the capital standards and also the question of, how useful of an instrument is it for tracking mortgage credit risk. So more to say on that probably in future research. Let me quickly turn to the study that Michelle Aronowitz, Jung Choi, and I did on the unequal cost of Black home ownership. And the headline number was that Black homeowners over the life of home ownership pay about $65,000 more in the cost of home ownership, attributable to various factors, but really three of them sort of that we highlighted on that. One is the use of risk-based pricing. Black homeowners tend to have higher LTVs and lower credit scores. That attributed to a significant fraction of that $65,000 higher cost, I think about 40%. The other one that comes up and is related to what Michael was talking about is Black homeowners are less likely to refinance on that than white homeowners. And again, it's because of the inability to refinance due to the re-underwriting of mortgages for looking for employment, DTI, and the like. It tends to slow down the refi rate. That also accounted for a significant fraction of that higher cost. And then the third one is that it turns out that tax assessments tend to, for the same house, tends to be higher for Black homeowners. Taken in total, we found, and that, by the way, was research that was done by others and we just referenced. Those three factors really add up and account for that $65,000 more of Black homeownership. Policy alternatives, one thing we sort of challenged was the use of risk-based pricing. That turns out to be more of a heresy than I think than I sort of realized. We limit risk-based pricing in lots of insurance markets. And the one that comes to mind is health insurance. There's a big debate going on right now about whether pre-existing conditions should be allowed to be priced on, either priced on or eligibility for insurance on the health side. We have made, at least with the Affordable Care Act, we made a policy decision not to allow risk-based pricing in health insurance markets for pre-existing conditions, even though pre-existing conditions is surely a higher cost to the insurer. And in some sense, what we're calling on in this paper is to have a similar, discussion of whether that's something we want to do, whether we want to limit risk-based pricing in the mortgage market. The second topic, of course, were the issue of refi. And Michael talked about, FHA's, steps towards helping expand credit. But really, these are, in some sense, just half steps, because When you think of it, forget about cash out refis. If it's a rate and term refi, you actually lower the risk to the system if you allow that refi to occur. So whether you're in forbearance, whether you're still employed, whether your FICO score is now 580, it still seems like we've made a decision to basically lock people out of the refi market, even though the Fed, as we've talked about, has lowered rates. We basically do not allow everyone to benefit from that. And I think we should, while I applaud FHA's steps in that direction, clearly the mortgage market could move a lot further and basically ease up and not re-underwrite the borrower for a term and rate refi. And again, this has a differential impact, differentially affects Black families more than white families, but clearly affects a lot of people that could benefit from the lower rates, but basically are still in those mortgages, which, as Michael pointed out, have people paying on average 75 basis points more, and many homeowners paying at least 100 basis points or more higher on their mortgage than they need to. So that's, again, work with Michelle Aronowitz and Jung Choi, who's on this call today. And I think, calls into question about potential reforms in the mortgage finance system going forward. So with that, I'll turn it over to, I think, Lori, for you to host
Yes.
the questions.
Yes, thank you. And thank you very much, Ed. That was fabulous. And actually, we had gotten a few questions in advance on the paper that you wrote with Michelle and Jung. So let me actually start there because that just flows very nicely. The first question was, at the end of the MIT study, it states that we know enough to make substantial improvements now. You recommended a couple of improvements on the call, minimizing the use of risk-based pricing and no re-underwriting of refis. What other improvements would you recommend?
Yeah, so the first two, I think, the first two can be done very quickly, which is we could eliminate LLPAs from the GSE pricing. When I joined Freddie Mac a long time ago, basically there was flat pricing and they did quite well. The advent of risk-based pricing really didn't occur to more like the late 1990s and the like. So that one, I think, is simple and could be done very quickly, along with this not re-underwriting. I think the other two areas that we should think about, and people have started to talk about, is really expanding basically down payment assistance. Most down payment assistance, comes from parents and family. But if people don't have, aren't fortunate enough to have family members who can help them with their first down payment, we basically could come up and expand, whether it's through tax credits and the like, down payment assistance. We could, and people have suggested doing this through baby bonds and all sorts of other mechanisms. But there's no reason we couldn't promote homeownership for people who've had generational, discrimination and as a result have much less wealth. So I would really call for that. The other thing I think we should think about, we provide mortgage insurance for the investor, which is great. We remove the credit risk from mortgages and make it a liquid product. But we don't provide mortgage insurance for the homeowner. So many countries have done this. We've tried it in the past. Certain states do it. But I would think it's also a renewed we should have a renewed effort to really innovate in this market and provide mortgage insurance for the homeowner. So rather than having to invent forbearance programs, overnight every time we have a crisis, why not, if someone runs into unemployment, why don't we have a product that allows them to have their mortgage paid for so that they don't have an effect on their credit score and the like? It's not that costly. It can be underwritten. And if we provide sort of scale and liquidity in that market, That would be the fourth area that I think that, the time is ripe to consider.
Thank you very much. There's one other question on the white paper regarding the variance of appraisal values and the devaluation of majority Black neighborhoods by as much as $48,000. I know that you cited the research. This wasn't original research there, but I didn't know if you wanted to comment on that point.
Yeah, it was sort of, more needs to be done. I'm not an expert on tax appraisals, and it's, very much county by county, the practices. But it shouldn't be too surprising that, that for a variety of reasons, whether it's that Black families, homeowners, appeal their assessments less often, or when they do appeal, they are less likely to have favorable rulings. It seems that over, time, this has really mounted up, and I think the number was that they have assessments of about 13% higher on if you just multiply that out on a $300,000 house, 13% is $39,000 higher. The average tax assessment is a little bit over 100 millage or 1%. So that's roughly $390 of higher payments. And so in some sense, I was a little surprised at this result. Another part of me says, yeah, I'm not really that surprised. It's just another area where over time, for a variety of societal reasons, things have just added up. And we now have a significant issue, or at least, again, that the research would tend to point to this. Again, this is tax assessments. There's another interesting set of research issues that I know Urban has looked at, which is, house price appreciation within neighborhoods that are, a higher percentage of African-American families. That's a different set of research. County tax assessments are never 100% the same as market value of the houses. So you guys have done interesting research on that set of issues too.
Thanks. And then let's actually turn to FHA. Is there question that came in? And by the way, if anyone has any questions, please put them in the chat and we'll be happy to answer them. But there are two more questions that came in advance. But again, put questions in the chat if you have any additional questions. There's a foreclosure. Is there a foreclosure crisis brewing? And what do you anticipate the impact will be on the FHA portfolio once the moratoriums are lifted?
Yeah. So, this is, in this case, on the single family side, I think both the GSE and the FHA VA space have come up with the right solution, which is if there are missed payments, in the case of FHA, it's a partial claim, but the money is put on the back end sort of as a soft second. So when you sell the house, you owe if there's equity, you owe the money on that. That should prevent foreclosures. I think we learned the lesson of the last crisis is we did not do enough to prevent foreclosures. And I think we have, you can always do, needs to be monitored, and it depends on how it's implemented. But the general direction of don't worry about the missed payments, make it up at the back end is the right solution and should prevent foreclosures. And the partial claims, I mean, we're talking about pretty small amounts if it's just, the missed payments on 3% mortgages. 4% mortgages. That's not going to be a real strain to the FHA system. And the other thing, the FHA is a great built-in stabilizer. It is an insurance fund. And, if it pays out during periods like this, that's why we want to have an insurance fund. So I don't see any real strain. It's always worth pointing out that a topic of a different day, but we haven't solved the issue on the rental side. What happened? We haven't forgiven the rent. We basically have just kicked the can down the road. But I think on the home ownership side, we seem to have come to a pretty good solution. And I'm not terribly worried about the losses, even if you see, I think it's 7% of FHA being in some sort of forbearance. that is something that the fund can handle. After all, it does have full faith and credit behind it.
Great answer. Just let me add one more thing, and that's that people have record equity in their home right now. It's just so different than the financial crisis.
Absolutely.
And then we've got one more question on the dislocation of home prices this year regarding price tiers, geographic location, and supply-demand mismatch. I think Kate did a very nice job covering that. I don't know, Ed, if you have any additional thoughts there.
No, I mean, there's a lot of anecdotal, people have, I think part of the question are whether whether the central city, near in suburbs, people are trying to move out more to rural housing and the exurbs. I think it's just too early to tell. There's always a couple of stories on that. The other thing, and I think Kate covered this very well, but when you're looking at tiering and whether one sector does better than another sector, the starting point always, things don't move exactly the same in every market. And so starting points, where's your starting point really will affect your conclusion on that. But I think it's too early to tell. House prices seem to be holding up, quite well, as you have, Urban has written about. At the end of the day, we just need more housing units created.
Yes, the record low inventories were just a stunning drop. Well, thank you very much, Ed. What I'd actually like to do, and we don't seem to have any questions in much in the way of questions in the chat, is talk about some of our recent work. The Urban Institute has mounted a big effort to get data and analysis and convene thought leaders in response to the COVID-19 crisis. In the housing space broadly, we have two significant efforts happening. We have the Mortgage Market COVID-19 Collaborative, which we're running out of the Housing Finance Policy Center. This collaborative is bringing together mortgage industry stakeholders, consumer advocates, and researchers to share data and policy ideas and develop collaborative solutions that will ensure sustainable homeownership stability and equity in response to the COVID-19 crisis. And you can learn more about the participants and the work on the Housing Finance Policy Center landing page. We also, Urban's president, Sarah Rosen-Wortel, is heading up an effort to stabilize the renter market through the Renters and Rental Market Crisis Working Group. This working group, which the Housing Finance Policy Center researchers are also involved in, brings together advocates, industry, policymakers, and philanthropic organizations to share data and policy ideas and develop collaborative solutions that will stabilize renters and multifamily owners during the response to the COVID-19 crisis. Since our July call, we've hosted 3 webinars: How Changes in Property Taxes Shape Communities, 2 case studies; Exploring Proposals to Update and Strengthen the CRA, the Community Reinvestment Act; and Measuring the Crisis, Housing Data During the COVID-19 Pandemic. The last webinar was last week. You can watch recordings of all 3 of these events on the Housing Finance Policy Center landing page. And in particular, Measuring the Crisis Housing Data During the COVID-19 Pandemic was just an excellent webinar for those of you that are data geeks. We've also published 7 research briefs in the last 3 months, 3 of which are COVID related. The others examine split roll property tax reform in California, local housing market conditions in Newark, New Jersey, and the CFPB's proposed QM rule, as well as the proposed FHFA rule for GSE capital standards. We've published 12 blogs since our last call. All but 2 are specifically related to COVID. All of these blogs and publications are available on our landing page. In terms of upcoming work, in the coming weeks, we'll be releasing additional research on small loans as a method to promote Black homeownership, racial disparities in home valuation, and we'll continue our work on the ongoing impact of the COVID-19 crisis. So with that, thank you all very much for joining our call today, and we'll see you in 3 months for our next quarterly call. Take care, everyone. And again, thanks for joining.